I used to believe every one of these 9 money myths, and they kept me broke. Now I've spent the last 20 years helping people unlearn this stuff, right? And build real wealth instead. So number 1, debt is always bad. If you've been watching the Ramsey show or anything like that, you know that debt is evil. It's horrible. It's even against the Bible.
And the Bible does not say anything good ever about debt.
But here's the ironic thing. Why does Jesus actually use debt in the parable of the talents, using 3 stewards who borrowed money from their master, and then the ones that actually made money, those are the ones that were rewarded. The one that buried it and paid it back, just paid off his debt, was the one that was cast out. And that kind of leads to the next thing. Speaking of cash flow, you need to budget. The budget, the B word, right? You do need to track your money first. That should be the first step. How can you create a budget when you don't even know how much you're spending? Track your money first for 6 to 12 months, and then you create what I call a spending plan. Because the truth is that money is meant to be spent. Even if you spend it into savings, it's being spent. Money is meant to be used. Instead of budgeting, create a spending plan instead. The third one is save all your money into stocks. If there's ever a way to invest money or save your money for retirement, it's always in the stock market, mutual funds, and those sort of things. And so I'm not saying you don't put money in the stock market. It's okay if you want to put some money in the market, but don't throw all your money in, putting all your chips in, hoping that's going to work out when the vast majority of people retire with less than $1 million, which means they have to live on less than $30,000 a year, and that's just not acceptable. The fourth myth you'll hear is that the S&P 500 will never fail you. Because here's the thing, is that the S&P 500, one, is not diversified. Did you know that the top 7 stocks, which are really 6 companies, because Google counts twice, the top 6 companies make up over 1/3 of the S&P 500. So the S&P 500 is not really that diversified, first and foremost. But secondly, the S&P 500, although they tell you it's like 10, 12% a year, guess what? It's not. It's making maybe 8% a year. The last 30 years, up until April of 2025, has been 8.03% average of the S&P 500. Yes, it has gone up over time, but here's the problem. What if you try to retire and then the market tanks right before you try to retire? How long do you have to wait before the market comes back up? It falls fast, but it goes up slowly. That's where it can fail you. 5, financial advisors know best. I'll tell you, like I mentioned, I was a financial advisor before. About 25 years ago, I was a financial advisor, did that for 4 years. And what I realized was this, is that we're the blind guides leading the blind. My friend made this apparent to me. He asked me, he said, Chris, how many of your clients are financially free where they don't worry about money? And I said, well, even the ones that have been investing with other advisors for decades, none of them, they all worry about running out of money. Okay, Chris, how about this? How many of you guys as financial advisors are financially free, not off the commissions, but actually doing these investments? And when I realized there was guys working in my office since the late 1970s and they still couldn't retire either, that's when I realized they're just as broke, they're just as clueless about investing as everybody else. The 6th one, making a lot of money, making high income means you're rich. This is 100% false because why? A lot of our clients are high income earners. We have a lot of people that are middle to upper middle class, sometimes even upper class that work with us. And I'll tell you, when you start to go into the deep, dark secrets of their mind, they're just as worried as you are. Now, granted, from the outside, it looks great. They do take great grand vacations. They're able to do some good things. But here's what they're thinking while they're on vacation. They're thinking, I'm not making money while I'm on this vacation. They're thinking, I have to go back and work. In fact, for me to keep this lifestyle going, I have to keep working and working to keep up this kind of lifestyle, this expectation that my family and I now have. 7th, pay off your house. Well, here's the problem with paying off your house. What does it do for you? Now, until it's fully paid off, it does nothing, right? Until that mortgage is paid off, you don't free up any money. But here's the problem. When you have a house, you still have expenses, you still have taxes, you still should be paying for insurance, you still deal with upkeep and maintenance and everything else. Your house is not an asset in this case. It becomes a liability. It becomes an expense. It becomes something that sucks your money away and you start to hate it. 8, the employee match is amazing. You have that 401k, the employer puts in that 50 or 100% match up to whatever percentage they tell you they can pay it. And it's amazing. It's 100% rate of return, as they say. Do the math. If you ever put into a compound interest calculator what you're putting into your 401k, go ahead and put in a 108% return, right? Let's just say it's 8% with the market, 100% with the match, and see how much money you have in 20 years. I can promise you, you will not have literally trillions of dollars if you put that number in. You will not have trillions of dollars in 20 or 30 years. The match is great. It helps, but here's the problem. The 401k funds, like Fidelity, for example, the funds that they pick for you underperform the stock market. So they actually do worse than the stock market. So the match, what does it do? It just gets it back up to where you make stock market returns. You could literally be investing in the stock market and have the same returns as in a 401k with a 100% employer match. And then the last one, the ninth one, and this one's important, is that real estate is risky and it's time consuming. I thought the same thing. I was a financial advisor. I was telling people, don't do real estate. It's risky. Forget about it. Just go in the stock market. Partly I was saying that because I only get paid if you put money in the stock market like every other financial advisor. But secondly is that real estate doesn't have to be risky. In fact, real estate has real assets backing it up. What do stocks have? It's all based on what people feel about a company. It's not even mean that it has to be worth anything. It's all based on feelings and emotions. Fear and greed drives those prices up and down. You do nothing for it. But with the real estate properties, they don't go up and down like that. They don't change from day to day. You don't lose like what we saw in the market. 3 days, people lost 10% or more of their money in the market in just 3 simple days. That never happens in real estate. Never. It takes way longer if anything like that happen, and it happens so rarely. Real estate does not have to be risky if you know what you're doing, and it doesn't have to be time consuming. You could be a hands-off, passive investor with those people that are actively investing in real estate and make money from that. You could be the bank with those people. So the myth about real estate being so risky is costing people a fortune, but I'll tell you, there's more to it than that. So in this next video, I'm gonna show you what smart people are doing instead with their money and how to grow your wealth without wasting years on this bad financial advice. Click here and see what you've been missing.